Dave Lee, host of a popular investment-focused YouTube channel, is also known for his enthusiasm for Tesla vehicles. He posted that he had raised funds for Tesla shares 100 times their actual value. He said he bought Tesla shares anticipating a tenfold increase in value from $3 billion to $40 billion. Now he has said that it is possible for the past to repeat again. How come he thinks that? Can I have the analyst's head count? To find out more, stay tuned. In the same way that people misunderstood the initial iPhone, Lee argues that this is happening with Tesla. He thinks Tesla is only at the beginning of its journey toward complexity through innovation. The investor was surprised to see that holding common stock in Tesla led to a 100-fold increase in value in just over 8 years. In his estimation, the stock price will increase much more, perhaps by a factor of 100, within the next 8 years. Given the current state of the economy, Tesla's quarterly results were particularly impressive, as regular viewers of this channel are well aware. Tesla had a fantastic quarter, with revenue of $18.7 billion, up 81% year over year, crushing estimates by $3.32 billion. Despite widespread anticipation that Musk would reveal Twitter's future plans, he instead discussed Tesla. Here are a few of the most important points we learned during Tesla's earnings call. Barron's reports that Tesla has exceeded everyone's expectations, even Wall Street's. The $2.20, $2.30 per share, and $18 billion in sales that Wall Street had predicted for Tesla was easily surpassed. Additionally, the company's operating profit was almost $1 billion higher than market watchers had predicted. After-hours trading saw Tesla shares rise by 5% to $1,017 from the close price of $976. Lee claims that far too many investors and employees put their faith in their own interpretations of the earnings report when assessing the company's performance relative to analysts' estimates for earnings per share, EPS, revenue, margin, and other indicators. He added that this approach was flawed since analysts were not familiar with the vast majority of common stock. Some analysts work for companies where they don't even own stock, thus it makes no difference to them whether the company's profits impress or dismay them. Young, high-growth companies often face discrepancies between investor and analyst expectations. However, this is consistent with the fact that Tesla has been meeting or above analyst estimates for some time. Consider Tesla's financial performance in the first quarter. The numbers were better than expected, but in line with what investors were anticipating. Financial experts were taken aback because they had been concentrating so intently on analysts' predictions and the margin by which Tesla had surpassed them, rather than on investor expectations and the extent to which Tesla had exceeded them. Lee argues that Tesla's failure to significantly exceed market expectations meant the company lacked the initial momentum necessary to continue pushing and setting new records. Because devoted investors already had high expectations for Tesla and its management, especially in light of good delivery data, the stock gained by only 6% after the earnings call and release. This should have been expected. Lee claims that earnings are the primary factor in setting stock prices. Limited production was a factor in Tesla's disappointing first quarter performance and the stock's failure to set a new high. Credit Suisse reports that on March 28th, Tesla's Giga Shanghai facility was shut down as a result of the increased attempts to limit COVID-19. At the close of the first quarter, the idling started. Since the Shanghai plant is the largest in terms of output, a potential drop of about 90,000 vehicles in the coming weeks was anticipated to have a significant effect on the company's performance in the second quarter. Despite the fact that Tesla's Shanghai Gigafactory, which produced over half of the company's cars last year, was shut down for several weeks due to China's zero-COVID crackdown, we are still optimistic because Tesla's management appears to have things under control. Tesla has stated that current quarter deliveries should be flat compared to the first 3 months of the year. It is anticipated that 1.47 million units will be shipped this year. Lee thinks that Tesla has to show revenue growth to maintain its bullish surge every quarter. As Tesla has indicated, it still expects to increase production by 50% by the next year, so they should produce more autos than investors predict, and revenue should also exceed expectations, driving the stock price higher. It's logical to assume that the stock price will rise. Not just Dave Lee is bullish on Tesla's prospects through 2030. In its investor letter for the first quarter of 2022, Warm Capital had a lot to say about Tesla. They anticipate a return of at least 10 times their investment in Tesla shares by the year 2030. The firm's largest stake, Tesla, has seen rising optimism in recent months, and the company reflected that optimism by raising its Tesla shares in the first quarter. They expect Tesla to have superior long-term performance compared to the S&P 500. According to them, Tesla has at least 10 more years of improvement to make. Similar to how Amazon emerged from the Nasdaq bubble and the financial crisis, the company is just now entering a period of fast, rapid expansion. Investor Gary Black has some intriguing predictions for the future of the Tesla brand of electric vehicles. He claims that Tesla's valuation ought to be $4 trillion. On $100 in earnings per share, the current market cap is $1.09 trillion. He projects a $30 P/E ratio, which would put the price at $3,000. Black predicts that by 2030, 60% of all cars sold worldwide will be electric, which would put Tesla's market valuation at close to $4 trillion if 1.4 billion shares were outstanding. By 2020, Tesla will control 20% of the global market for electric cars. According to Black, sales of light automobiles around the world will exceed 85 million units by the end of the decade, and Tesla will be delivering around 10 million vehicles annually by then as well. However, things could worsen before they improve. According to analysts, in April, Tesla's stock dropped from a high of $1,152 to a low of $972, with frequent fluctuations around the key $1,000 barrier. Where did all that chaos originate? High-tech stocks are losing favor with investors, as evidenced by the recent performance of Apple and Microsoft. However, concerns have been raised about the prevalence of COVID-related outages in China. Given the situation in Shanghai, it seems unlikely that Tesla will be able to reach its delivery targets. In a note to clients on Tuesday, Tesla's CEO Dan Ives of Wedbush also raised some concerns. One analyst, Ives, says that the severity of China's manufacturing woes and the implications for the rest of the year's delivery in the second quarter are tomorrow's top concerns. Since there are so many unknowns regarding second quarter China production, it will surely weigh on estimates for the rest of the year. Musk and co. are in a precarious position. Thus, there has been a glaring cloud over the stock for the past month. Cathie Wood, a stock market expert who has been bullish on Tesla for a while now, doesn't seem worried by these worries. Her company, ARK Invest, predicted that by 2026, a share of Tesla might be valued as much as $4,600. Prior projections indicated that the stock price will reach $3,000 by the year 2025. An earlier analysis predicted a price of $5,800 by 2026 under the bull scenario, with the bear case predicting a price of $2,900, which is still over 3 times the present price of $1,005. ARK anticipates a near tripling of Tesla's value by 2026, even in the worst-case scenario. Although our Tesla model is calibrated to our 2026 forecasts, we feel it is methodologically conservative, the investment firm wrote in a message to shareholders. According to ARK analyst Tasha Keeney, by 2026, Tesla's stock will trade like that of a mature firm rather than a fast-growth one. Key to this is the belief that Tesla will improve its capital efficiency. This has resulted in a decrease from $84,000 in 2017 to $7,700 this year in Tesla's capital expenditures per incremental unit of capacity. Dave Lee has said more than once that he intends to hold on to his stock for the long haul, and he still has optimism that Tesla will have remarkable growth by 2030. Kelley Blue Book reports that Tesla has the highest first-quarter sales of all electric vehicles in the United States. 75% of the first quarter 2022 sales of electric vehicles were Tesla automobiles. 68% of all electric vehicles sold in the United States were Teslas, specifically the Model 3 and Model Y. Those numbers suggest that in the third quarter, Model S and Model X sales made about 7% of Tesla's total. With the help of its gigafactories in Shanghai and Berlin, as well as its new headquarters in Texas, Tesla will have to expand as competition increases in the electric vehicle business. It would appear that Elon Musk's business is prepared to defend its title in 2022. By 2023, Tesla hopes to have begun production on its other cars, including the Cybertruck, Semi, and Roadster, with a total annual manufacturing capacity of 1.5 million autos. Can you predict the value of a Tesla share in 2030? Leave your thoughts in the comments.